I ran the 3 greens and 3 red flags audit on Capital and Integrated Commercial Trust once before, and the result was uncomfortable enough that I knew I had to come back. The Paragon acquisition changed the portfolio strategy. The balance sheet numbers, though, have not changed in the direction most holders are hoping for. When we look across Singapore Exchange, it is easy to get blinded by a steady dividend stream. But a forensic approach means looking directly at the vulnerabilities. The 4.84% trailing yield tells us the current distribution is real and hitting the account. That clears the initial requirement for a core income holding. The balance sheet, though, tells a completely separate story. Aggregate leverage has pushed up to 38.5%. The interest coverage ratio has compressed to 3.8 times. Both of those are immediate breaches of my internal forensic flaws. The structural safety margin for income investors is actively thinning. The operating performance across the portfolio remains intact. Income growth is real, driven by the full consolidation of Capita Spring and the completed handover of the Galileo property in Frankfurt. But as forensic investors, we have to look at how that income is being funded. The yield looks attractive until you read the balance sheet behind it. And the capital structure is under clear pressure. We cannot evaluate distribution sustainability without going deep into the liabilities. Looking directly at the primary financial update from the first quarter, gross revenue reached 426.7 million Singapore dollars, an 8% jump year-on-year. Net property income grew 7.9% to 314.4 million. Both score clean passes against stable benchmarks. But the capital structure reveals 2 flat failures. Aggregate leverage stands at 38.5%, missing my house threshold. The interest coverage ratio has landed at 3.8 times, below my mandatory 4 times floor. Note that management does not disclose a quarterly distribution per unit during the business update, so our baseline rests on the historical full-year payout. My job when auditing Singapore Exchange is straightforward. Even if the underlying balance sheets are complex, I rate the exact operational metrics that the mainstream headlines skip past. Interest coverage, structural gearing, free cash flow sustainability. The goal is to ensure that the everyday Singaporean building or living off a dividend portfolio gets the same forensic clarity that institutional money takes for granted. Let us establish the first positive operational pillar, the distribution yield. Based on a full-year distribution per unit of 11.58 cents and a market price of $2.39, the trailing yield sits at 4.84%. That clears my house hurdle of 4.7%, which is the absolute minimum income threshold before a security can qualify for an income portfolio. Forward projections from JP Morgan point to an expansion toward 5.11%, while broader consensus tracks at 5.02%. Be aware that some platforms incorrectly show a yield of 6.48% due to a passing error on an advance payment. Do not rely on that inflated figure. The income growth engine supporting this distribution is structural, not manufactured from temporary windfalls. The first quarter revenue increase to 426.7 million Singapore dollars is backed by real operational assets. The trust stepped up to a full 100% interest in Capita Spring, which began contributing completely from August of last year. The asset handover at Galileo in Frankfurt was largely finalized in the first quarter, locking in stable recurring income streams from highly creditworthy institutional tenants. The second positive factor centers on the massive institutional scale and credit backing. As the largest commercial REIT in Singapore, the portfolio holds dominant retail and office properties across elite locations, including Orchard Road, Raffles Place, and the wider central business district. This asset dominance, paired with a strong sponsor in CapitaLand and ultimate Temasek ownership, provides immense structural stability. Moody's affirmed an A3 rating with a stable outlook. Standard & Poor's confirmed an A- rating. Institutional credit remains rock solid. On the actual cost of capital, management has executed well against their own corporate guidance. The average cost of debt fell to 2.9% as of March, down from 3.2% at the end of December. That reduction was driven by the issuance of a $300 million fixed-rate green note at an interest rate of 2.18%, locking in cheap funding all the way out to 2031. 76% of total borrowings are hedged at fixed rates, which significantly reduces vulnerability to fluctuations in the Singapore overnight rate average. The third positive driver is the major strategic portfolio repositioning centered around Orchard Road. The announced acquisition of Paragon for 3.9 billion Singapore dollars at a net asset yield of 3.9% represents a disciplined approach to recycling capital. To fund this transaction, the trust is divesting Asia Square Tower 2 for $2.476 billion at an exit yield of 3%, capturing a 9.9% premium over independent valuation. Shifting capital out of a lower-yielding leasehold office building into a higher-yielding freehold retail and medical asset makes complete structural sense. When we look at what Paragon brings to the portfolio, the benefits are clear. The freehold tenure removes long-term lease decay risk entirely. The property brings a historical track record of full committed occupancy. This transaction directly exposes the trust to Orchard Road's tourism recovery tailwinds, and when combined with the divestment, delivers a pro forma distribution accretion of 1.7%. An organic asset enhancement pipeline at Plaza Singapura and Capital Tower running through 2028 will deploy $160 million at a projected 7% return, driving further organic expansion. Now we pivot to the critical balance sheet vulnerabilities, starting with structural leverage. The aggregate leverage ratio stands at 38.5% as of March. The Monetary Authority of Singapore sets a statutory limit of 50%, meaning there is zero regulatory breach. But this figure clearly violates my internal retirement ceiling of 35%. Running a core income asset at this level leaves a compressed safety margin, especially if temporary bridging loans push leverage up to 38.7% before divestment proceeds are fully finalized. The auntie in Bedok drawing down her SRS account each month cannot afford to discover the trust she relies on has no buffer left when the property cycle turns. At 38.5% gearing, any asset devaluation or unexpected capital call leaves almost zero safety headroom, threatening the stability of the distribution when macro conditions deteriorate. The second red flag is a more immediate operational concern. The speed at which the interest coverage ratio is softening. The ratio currently sits at 3.8 times. That is a direct failure of my mandatory 4 times floor for a retirement sanctuary asset. Current earnings cover the interest bill 3.8 times over, but that buffer protects investors poorly against external shocks, making the capital structure sensitive to prolonged high-rate environments. The true risk becomes clear when we look at the stress scenarios within the trust's own financial disclosures. If the floating rate benchmark governing the unhedged portion of the debt book moves up by just 100 basis points, the interest coverage ratio compresses down to 2.9 times. Separately, if broader portfolio earnings soften by 10%, the ratio contracts to 3.4 times. While these drops are statistically unlikely given high fixed rate hedges, the key takeaway is how little distance exists between the current baseline and real financial pressure. Visualizing this interest coverage trajectory shows exactly how fast the safety margin erodes under minimal asset stress. For a retired investor relying on these quarterly distributions to cover the monthly grocery run at the neighborhood fair price, a capital structure that degrades this quickly toward a restricted threshold cannot be classified as a defensive safe haven. We must demand a debt structure that can absorb higher financing costs without immediately threatening the cash distribution flowing down to retail unit holders. The third red flag is a localized deterioration within the commercial office portfolio. Total office occupancy dropped to 93.7%, a 2 percentage point decline in a single quarter, falling below my 95% floor for prime central commercial assets. This drop was primarily driven by the main airport center in Frankfurt, losing an anchor tenant at lease expiry, alongside a material tenant vacating the Funan office development, creating a vacancy gap that management must now aggressively resolve. Management is responding with active releasing campaigns across the affected office assets. In the first quarter, new and renewed office leases totaled over 121,000 square feet, securing a tenant retention rate of 68.9%. The forward leasing pipeline is targeting higher quality tenant profiles: banking, insurance, financial services, and technology firms. These professional categories bring longer lease commitments and higher rental stability. The near-term vacancy drag, though, will continue to weigh on net property income until these spaces are fully operational. In this market, the difference between a sanctuary and a yield trap is often decided in a single trading session. By the time deep forensic analysis reaches a free subscriber, the valuation window has already moved. To act on these structural mispricings, an investor needs to review the underlying balance sheet adjustments the moment the data goes live, not after the market prices it in. Before we go deeper, if this forensic breakdown is useful to you, the single most useful thing you can do for the channel is hit subscribe. It takes 2 seconds and it tells the algorithm that data-driven SGX analysis deserves to exist. Members of Iggy's elite investors secure immediate 0-day access to these forensic deep dives when the numbers still matter, alongside full visibility on the Red Zone watchlist and institutional-grade cheat sheets. For $9 a month, which is less than a coffee and toast set at Raffles Place, you move away from being passive exit liquidity and start operating with institutional clarity. To properly judge the value of a 4.84% trailing yield, we must compare it against risk-free sovereign returns available in Singapore. The latest 6-month sovereign treasury bill pays 1.48%. The CPF special account delivers a guaranteed 4% per annum. That means by holding this commercial trust, an investor is taking on significant gearing, interest coverage compression, and commercial office vacancy risk for an equity risk premium of just 84 basis points over a risk-free government guarantee. My yield framework uses a conservative stress test floor of 3.2%, which is never lowered to accommodate a low-rate macro environment. Add a mandatory 150 basis point risk premium to account for equity volatility, and we arrive at my house hurdle of 4.7%. The trust's trailing yield of 4.84% technically clears that benchmark, but clearing an income floor is merely a baseline requirement. It is completely insufficient on its own when an asset triggers two simultaneous structural gate failures. Based on the completed balance sheet audit, this stock is formally assigned to Zone 4 caution. The underlying property strategy is sound and the income is entirely genuine. But the safety buffers are thin. This asset passes for investors in the accumulation phase and carries a conditional rating for those in transition. For immediate drawdown portfolios, it is a flat failure. Leverage at 38.5% and interest coverage underperforming at 3.8 times. Iggy's forensic zone, Zone 4 caution. This structural profile fits a 48-year-old accumulator using SRS capital to build long-term dividend streams with a holding runway of over a decade and the capacity to absorb short-term capital volatility. It is not suitable for a 63-year-old retiree managing a strict cash drawdown portfolio where capital preservation is non-negotiable. An 84 basis point premium over a guaranteed sovereign return does not compensate for these structural risks. Let us address the yield illusion visible on secondary financial platforms. Several data providers are displaying an inflated forward yield of 6.48%. That is a structural error caused by a misclassification of an advanced distribution payment. The true trailing yield is 4.84%, established using the verified full-year distribution of 11.58 cents against the current market price. Forward consensus numbers are tracking between 5.02 and 5.11%. Always audit the primary financial filings before executing a trade. The single forensic variable that will dictate a zone upgrade later this year is the precise execution timeline of the Paragon acquisition alongside the Asia Square Tower 2 divestment. If management transfers capital out of the 3% leasehold asset into the 3.9% freehold property cleanly without maintaining elevated bridging leverage, the structural gearing path will normalize. But if aggregate leverage remains pinned near 38% in the next reporting cycle, you need to ask yourself honestly whether your monthly retirement cash flow can safely absorb an unexpected capital call. This is not a broken operational story. The asset yield is real. The properties are dominant institutional-grade locations. Net rental income continues to expand organically. Capital recycling is moving in the correct strategic direction. The falling average cost of debt and extensive fixed-rate hedges show that management has a firm grip on the capital book. But the balance sheet is running with a compressed margin for error, and the two critical risk metrics remain outside my mandatory safety boundaries. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access. Link in the description. At 4.84%, the market is paying you just enough to consider the underlying capital risks, but nowhere near enough to ignore them. If the upcoming asset transactions settle cleanly without prolonged bridging debt and the interest coverage ratio climbs back above 4.1 times, this stock can earn its way back into a superior forensic zone. Until those balance sheet repair milestones are stamped in the half-year accounts, this remains a high-quality income asset under close observation, not a sanctuary-grade asset for drawdown retirees. 0-day access on Substack and YouTube, full Red Zone watchlist, and institutional-grade cheat sheets for $9/month. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. Stocks assessed under Iggy's forensic yield standard are benchmarked against a 4.7% minimum yield hurdle. Stocks flagged as Growth Watch fall below this threshold, but demonstrate clean balance sheet metrics and an identifiable growth catalyst. These carry a materially different risk profile and are not suitable as yield replacements for income-dependent investors. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged.